Both Shell and BP are riding the same oil price surge, yet they are making structurally opposite bets about what comes next. Brent crude moved from roughly $60 a barrel at the start of the Iran war to $114 by the time first quarter results landed. That is not a gradual drift. It is a doubling of the input that drives every line on an oil major's income statement. Both companies reported strong numbers as a direct consequence. But here is the tension worth examining. Shell responded by committing $16.4 billion to lock in more production capacity for the rest of the decade. BP responded by doubling its profit, then refusing to restart share buybacks, citing an outlook it described as highly uncertain. Same oil price, opposite conclusions about durability. That divergence is not a minor stylistic difference between two management teams. It is a live question about whether the current price environment is a structural shift or a war premium that could unwind the moment geopolitics move. The answer to that question determined which company made the right call, and the evidence is not yet settled. Shell's ARC acquisition reveals what CEO Wael Sawan actually believes about the oil price cycle, and it is more committed than the cost-cutting narrative his tenure began with. The deal is Shell's largest since the BG Group acquisition a decade ago. At $16.4 billion, it adds 370,000 barrels of oil per day, pushing Shell toward a target of 1.4 million barrels per day by end of decade. The structure, 75% shares, 25% cash, paid at a 20% premium to ARC's market price, means Shell is using its own elevated equity as acquisition currency while preserving balance sheet flexibility. That structure is worth pausing on. Shell carries approximately $45.7 billion in net debt. Paying primarily in shares rather than cash is a deliberate choice at a moment when Shell's stock is near multi-year highs. It transfers some of the oil price-driven valuation premium directly into the deal economics. What most commentary has focused on is the production addition. What is being underweighted is the strategic reversal embedded in the transaction. Shell has abandoned several wind and hydrogen projects in recent quarters. This acquisition is not a side move. It is a formal declaration that Sawan's version of the energy transition involves doubling down on hydrocarbons while oil remains above 100. The CEO's own language framed Canada as a heartland, a word that implies permanence, not opportunism. The point most people are missing here is the BP acquisition angle. One analyst observation that circulated immediately after the deal was announced: Shell buying ARC effectively removes it from contention as a potential acquirer of BP. That matters because BP's activist shareholder situation has generated persistent speculation about a takeout scenario. Shell was the most logical strategic buyer. That door has now closed, at least for the foreseeable future. BP's Q1 result was strong enough to beat consensus by nearly $500 million. But the more analytically interesting signal is what BP chose not to do with that strength. Profit more than doubled from $1.5 billion to $3.2 billion against a consensus forecast of $2.7 billion. RBC Capital Markets identified refining and trading as the primary driver. The downstream business, not upstream production, carried the beat. That distinction matters because downstream margins are more volatile and less predictable than production revenue. A refining windfall in Q1 does not mechanically repeat in Q2. BP held its quarterly dividend at 8.32 US cents and declined to resume share buybacks. Net debt sits at approximately $25 billion. The stated reason was a highly uncertain outlook, which, coming immediately after a profit that nearly doubled year-on-year, reads as a deliberate signal rather than standard boilerplate. New CEO Meg O'Neill, the first female chief executive of a British energy major, is operating under activist shareholder pressure. In that context, withholding buybacks while profits surge is a two-sided communication. To the activist, it signals fiscal discipline over short-term capital returns. To the market, it signals that management does not believe current earnings are a reliable baseline. There is a material reason for that caution. Q1 results captured only the early stage of the oil price spike. Brent was still climbing through much of the quarter. The full impact of $114 oil will not appear until Q2 numbers. If Q2 confirms the earnings trajectory, the threshold for resuming buybacks becomes harder to justify deferring. If Q2 disappoints, because refining margins compress or demand softens, the decision to wait looks prescient rather than timid. The windfall tax dimension adds a further complication. Energy Secretary Ed Miliband publicly described profiting from the crisis as morally wrong. That political pressure has a direct fiscal translation.
Higher windfall taxes on UK-listed oil majors are a live legislative risk, not a theoretical one. Every billion added to reported profit increases the probability that Parliament revisits the tax rate. BP's management is almost certainly modeling that scenario.
The next 90 days function as a stress test for both companies' strategic logic, and the conditions that will resolve current uncertainty are specific enough to track. For BP, the critical variable is whether Q2 profit sustains above the Q1 level once the full oil price spike flows through the income statement. If it does, and BP still withholds buybacks, the activist pressure intensifies, and O'Neill's credibility on capital allocation comes into question. If Q2 beats again and buybacks resume, the hesitation reads as appropriate caution during a leadership transition, and the $25 billion debt reduction story becomes the central investment thesis. For SHEL, the verification event is different. The ARC deal closes at a price that assumed $114 oil provides durable justification for long-cycle production investment. If Brent holds above $100 through the acquisition close, the deal economics remain intact. The risk threshold is a negotiated ceasefire in the Iran conflict, or the UAE accelerating its exit from OPEC supply discipline, either of which could push oil back toward pre-war levels faster than the market currently prices. At $60 oil, the logic of paying a 20% premium for 370,000 additional barrels per day looks considerably different. Analysts have noted Brent could reach $120 if the war extends further. That scenario would validate Shell's acquisition timing and likely force BP's hand on buyback simultaneously. The convergence point, the single event that clarifies both companies' positioning at once, is the trajectory of the Iran conflict beyond Q2. Neither management team controls that variable, which is precisely why BP is withholding buybacks and Shell is locking in supply now before conditions potentially reverse. The asymmetry between the two companies' responses to identical conditions is itself the signal. Shell is betting on duration. BP is betting on optionality. One of those bets will look correct by the time second quarter results land, and the evidence currently leans toward BP's caution being the harder position to sustain if oil stays above $110.